everyone. Here we are again today at the Real Team One Group Engage office in the Real Team's office, talking to our favorite in-house lender, Brian Brackeen.
Thank you. Thanks for having me.
So today we have a really controversial conversation that we're going to talk to you about. Is it true that people who have good credit have to pay more in fees for mortgages or higher interest rates? Well, there might be some information that proves a little differently about that. So the two things that we're going to talk about now, is it a higher mortgage rate or higher fees that you have to pay if you have better credit? I came to Brian because I wanted to understand the truth. So he's here today to explain it.
All right. So basically what this is in reference to is on conventional loans only. It doesn't apply to FHA or VA, USDA, et cetera, only conventional loans. And what it's talking about is what's called loan level price adjustments. Basically a risk adjustment based upon you as a borrower. And really what they looked at, or the federal government in this instance, is based upon your credit score and how much you put down. And what they did in fact do was make changes that says if you have, say, higher than a 700 credit score, and you put somewhere between 25 and 10% down, your rate, your risk level, or your loan level price adjustment, your risk-based adjustment, did in fact get worse. It did.
Wow.
Less than a 700 score, that risk-based adjustment in fact got better for you. Your rate will be better than it was prior.
So Brian, that's crazy to me, right? So, we're working hard, we're paying our bills, we're making sure that we pay them on time in advance, and then you're telling us that people who don't pay their bills on time or have a couple slips maybe are going to be able to get lower rates than those that do the right thing?
Well, not necessarily.
Oh.
So there is a bit of a misnomer there, in that the rate that you would receive as a borrower is in fact better at higher credit scores. Now,
good news.
The adjustment that occurred kind of lessened the gap, I'll say. The gap between what it used to be if you had a lower credit score versus a higher credit score, say, was this big. Now that gap is this big. So overall, it is still in fact better to have better credit or to put more money down, towards the mortgage. So.
Okay, and so if I'm, great credit, over 700, I have a low debt to income ratio, what are some solutions that I can do to combat this higher interest rate?
So, one of the things that we really need to look at, and you really need to work with a mortgage professional on this, because they can help you. I happen to know one.
Me too.
They can help you kind of, I guess, navigate this scenario, because based upon how much money you actually have to put down, it may in fact be better to put less money down. Let me say that again. Based upon how much money you have, and assuming that you could qualify in either scenario, it may in fact be better for your interest rate to put less money down up front. You may in fact end up with a better interest rate.
So Brian, I'm sure you're about to get into this, but if you put less money down, don't you have to pay mortgage insurance?
You would in fact have to pay mortgage insurance. But what I would tell you is that, let's just say that you're a borrower and you intended to put 20% down so you could avoid mortgage insurance.
Sure.
And that you would qualify whether you did that or didn't do that, right? That's of course the underlying assumption there. You could in fact put down less money, get a better interest rate at closing, come back after the fact, put the rest of the money down, and eliminate mortgage insurance while still keeping the better rates. You're kind of double dipping in the process, or taking advantage of almost a loophole in the process associated with that. So it's very important though that you work with somebody who's versed in this and that can help you navigate it, because it's not easy, and a lot of lenders, they don't really look at this. They don't have the depth, they don't have the knowledge, and they don't do these kinds of things for their customers.
So, I have lots of buyers that I have reached out to you, and do you give them hypothetically scenarios 1, 2, and 3 that would help them to make a determination as to which way they should go?
Yeah, 100%. We always have a conversation in depth. Any questions that you would have, we would answer those questions in depth. Because ultimately, I look at it like this. This is your loan. This is not my loan. I'm helping you with it. I'm your consultant. But ultimately, you're the one that's going to make the payments over the next several years. And so I want you to be comfortable with it. I want you to understand it. If you have any questions whatsoever, please ask. I need you to understand it because, again, that's the only way that you're going to be comfortable at the end. It's the only way you're going to be satisfied at the end is if you, in fact, understand it in depth. So, yes, I would provide scenarios. I would provide recommendations for you. But ultimately, you're going to make that decision because you're the one, it's your mortgage.
Awesome. So we addressed the fact that people who have good credit still are going to be able to qualify for better rates. Now, what did this do for people who have the lesser than credit or poor credit?
Yeah.
What does that do for them?
Yeah, ultimately, if you had a sub 700, less than 700 credit score with a conventional loan, your interest rate got better associated with this change. And what does that translate to? Ultimately, it translates to either a lower payment or you qualify for more utilizing conventional loans. Now, it doesn't mean that we shouldn't look at other potential loan options. There may be other programs that are in fact a better fit for you. And oftentimes, if you're sub 700, and I would even argue now sub 750, that we should look at other loan options for you and see if in fact it's better than conventional.
Awesome. Anything else you want to add to this, Brian?
No, I hope that we were able to at least address some of the rumors that were out there, and I know this has been a big story across all the major networks and news programs. So hopefully, this was helpful.
Absolutely. And if you have any questions, you can reach out to myself or Brian, whether it's in terms of how you are going to set up a plan, because plans are very important. And Brian is really good at helping potential buyers get on a plan. You might not be ready to buy today. You might not want to purchase in this environment because you're nervous. We are here to help you. It's definitely always better to pay yourself than to pay someone else's mortgage.
100%.
Have a great day.
Thank you.